Whenever the markets get a little shaky, every investor asks themselves the exact same question. Where should I put my money? For centuries, that answer has often boiled down to a classic showdown between two precious metals. But what if we could predict their next move with almost perfect accuracy? Okay, let's dive right into this. Right? This is the ultimate safe haven debate. Do you go with the steady, reliable, old school standard, or do you take a chance on the more volatile, high potential upstart? Well, today we're going to look at some really fascinating research that uses a new kind of AI to give us a surprisingly clear answer. So, first, let's just set the stage. We're living in a world of economic ups and downs, and, making the right investment choice has never felt more critical. Yeah, according to the research we're digging into, the global economy is kind of stuck in this recurring loop of uncertainty, and it's expected to last right through 2025. This puts a ton of pressure on investors to find strategies that can actually protect their assets. And that's the exact problem this study set out to solve. And that brings us to our two main characters. On one side, you've got gold, the traditional safe haven, right? It's valued for its stability, its scarcity, and it has a proven track record when things get rough. Then on the other side, you have silver. It's way more volatile, but its high demand in industry, plus the potential for much bigger returns, well, it makes it a really tempting alternative. So you have two very different personalities and two very different bets. So how on earth do you choose between them? Well, a team of researchers decided to just build a better tool. Think of it as a financial crystal ball, but powered by a really unique hybrid AI. Their goal was, simple but incredibly ambitious. Create a model that could forecast the prices of gold and silver with the highest possible accuracy, giving investors a clear-eyed view of what might be coming next. And to pull this off, they combined two really powerful concepts. Okay, so the first one is called fuzzy logic. What's so cool about this is that it thinks more like a human than a typical computer. Instead of seeing things as just black or white, true or false, it actually understands shades of gray. It can process these vague ideas like a price being kind of low or getting a bit expensive. And that is perfect for messy, real-world financial data. And the second piece of the puzzle is the Markov chain. This is just a brilliant way to model probabilities. The core idea here is super simple. The best predictor of what's going to happen tomorrow is what's happening today. Not what happened last week or last year. It just focuses on the most recent state to predict the next one. So how do they put these two together? Well, the fuzzy logic part looks at all the historical prices and groups them into these human-like categories like low, medium, and high. Then the Markov chain steps in and calculates the odds of the price moving from, say, medium to high. And the result? You get this hybrid model that's incredibly adaptive and way more realistic. Okay, now for the really exciting part. How did this new AI crystal ball actually do when they put it to the test against real-world data? The researchers used 2 full years of official daily price data straight from the London Bullion Market Association. They fed 95% of all that data into the model to let it learn the patterns. And then they used the last 5% to see how well it could actually predict the future. And wow, just look at this chart. This is for gold. The solid black line, that's the actual historical price of gold. The yellow dashed line is what the AI model predicted. The two lines are practically sitting on top of each other. It tracked the real price with just breathtaking precision. How precise are we talking? Well, the average error in its predictions was just over 0.5%. Seriously, let that sink in for a second. An error rate of 0.55%. That is just astonishingly accurate. Okay, but what about silver? The more volatile, unpredictable one. Well, would you look at that? Once again, the model's prediction, that yellow line, does an absolutely incredible job of tracking the wild swings of the actual price in black. Even with all of that up and down movement, the model was not thrown off at all. So for silver, the error rate was a little bit higher at 0.94%. But that's still an error of less than 1%. For an asset as famously jumpy as silver, getting this level of accuracy is a massive, massive breakthrough. So we know the model can predict prices with incredible accuracy, but for any investor, there's a much more important question, right? What is my actual risk? And to answer that, the researchers used a metric called value at risk, or VAR. It basically answers the question, what is the absolute most I can expect to lose on any given day? It's a way of putting a hard number on your worst-case scenario. And this chart right here just makes the difference crystal clear. With 99% confidence, the most you could expect to lose in a single day on a gold investment is 3.8%. For silver, that number jumps all the way up to 6.08%. I mean, you can just see it. Silver's risk bar is way, way higher.
Okay, so let's bring it all together. We have these near-perfect predictions and a super clear measure of risk. So, what's the final verdict on gold versus silver?
You know, percentages can feel a little abstract sometimes, so let's translate this into cold, hard cash. If you invested $10,000, your maximum likely loss on gold for one day would be about $380. But that same $10,000 in silver, it could see a maximum daily loss of over $600. Seeing the raw numbers like that, it makes the risk feel a lot more real, doesn't it? So what's the bottom line? Well, the study's data gives us a really clear recommendation. Gold clearly stands out as the lower risk asset. That makes it a much better choice for more conservative investors who are focused on protecting their wealth. Silver, with its higher risk but also higher potential reward, is probably better suited for more aggressive investors who are comfortable with a little more volatility. And look, this isn't just some academic exercise. As the researchers themselves conclude, this model provides a powerful, practical tool. It's directly useful for everyone from individual investors and big-time portfolio managers to the policymakers who are trying to navigate this uncertain global economy. It all just leaves you with this fascinating question for the future. We just saw a model predict the market with less than a 1% error rate. As this technology gets even better, are we going to reach a point where investing is no longer a gamble, but a solved equation? Or will human behavior always find new ways to keep things unpredictable? Definitely something to think about.